Hey guys, hope you had a great week. Hope you have a wonderful weekend planned ahead. I wanted to talk to you about where mortgage rates are today and also sort of the foundation of that and where we expect them to go and why rates are, what the markets are doing. First off, today, conventional rates are hovering in that pesky 7% range. If you're in a government loan, you're looking at low sixes, VA, FHA, USDA. Now, again, remember, one rate is not all the same for everybody. I was talking to someone the other day. They said, well, my friend said they got a rate of XYZ and mine's this. Well, again, how much are you paying in fees? How much are you, what kind of loan product are you in? What's your credit score? You cannot compare, you can't be sitting in a restaurant and go, I overheard someone got a 5% interest rate and mine's at 7. Well, are they in a government rate? You're in a conventional, your credit score is 620, there's maybe 800. They're putting 20% down, you're putting 3%. I mean, there's all sorts of things that play a role in that. But one thing that gets overlooked over and over and over, unfortunately, are points. Points are a way that banks and lenders get their money, and they flash a low rate thinking you're going to get a better deal. Sometimes a lower rate in the wrong structured loan can cost you tens of thousands of dollars. Not just over the life of the loan. I mean, it can cost you tens of thousands of dollars in a short time span. So talk to us. Let us help you in complete and full transparency what the total cost of your loan is going to be so that you can make an informed decision that's in your best interest, not just for the transaction, but for the long haul in your financial plan. Now, why are rates where they are today? Where do we think they're going to go? This week, we've had a choppy week in the markets. It started out off at the beginning of the week when the CPI report came in, and basically, again, the Feds are really focused in their monetary policy on inflation, as they should be. And inflation has been coming down. However, the core rate that was reported on Monday wasn't quite what was expected by the market. It's just like if I said, or analysts that we follow say that Apple stock, we're expecting their earnings per share to be a certain number. And if that number comes in higher, we're all going to buy the stock. If that number comes in lower, they all sell it off. Same thing happens in the bond market. If there are key indicators that just simply come in above or below what's expected, the market is reacting. Doesn't mean it's a bad thing. And I think that's really what I want to focus on today, is because when you step back, inflation is heading in the right direction. Just didn't hit the number that they expected this week. And ensuing traders, traded off the bonds. They sold the bonds off, and that wasn't good for interest rates. We have had a couple of days of rebounding. We're staying in the technical aspects of the charts. You look at the 200-day moving average, both in the 10-year Treasury and in the mortgage-backed securities, and we're okay. We're not really breaking those barriers, so I wouldn't hit the panic button. I don't think we're going to see 8% or 9% or anything like that in the near future. In fact, I do believe we will inch our way down eventually. Maybe conventional rates will see 6%, maybe even 5.5%. Government rates should see low fives, even upper fours. Again, when is that going to happen? Probably going to take some time. 6, 9, maybe 18 months. Very difficult, and in fact, impossible to day trade what that's going to entail. But just keep our focus on the housing market and exactly what's happening there. Obviously, inventory is low. I read a report just a minute ago where first-time home buyers, there's more first-time home buyers entering in the market than we've ever seen before. If you look at birth rates back in the, I believe it's the mid-'80s, early '80s, you think about it then, birth rates actually had a spike in this period of time. And it's those people that were born in that time frame that are really entering into the housing market. Obviously, age range differ. I mean, you might be 19 years old right out of college and you're buying a brand new house. But again, the data is showing that, basically that there are a lot more first-time homebuyers entering in the market, and the inventory levels are actually pretty low still. So pricing is going to continue to go up, demand's going to continue to go up, and when interest rates continue to drop a little bit over the next 12 months, guess what? It's going to continue to put pressure on that. So opportunity is right there in front of us. If we want to take that opportunity, we need to take it, or it's going to cost you more money if you don't buy a house now and you want to wait. So give us a call. Let us help you with that. I hope you guys have a great weekend. We'll talk into more details about anything you want to talk about, mortgage-backed securities, interest rates, housing market, anything we can do to help you, let us help. Thanks.